Near the end of an IRS personal income tax audit, after you've submitted documentation and discussed the case with the IRS revenue agent, you will receive a Form 4549 titled Report of Income Tax Examination Changes. This form will go over the adjustments the revenue agent proposes to make to your return, including the total tax due and the penalty for understating your tax liability. The most common penalties assessed by the IRS during a personal income tax audit are the 20% substantial understatement penalty, the 20% negligence penalty, and the 75% civil fraud penalty. These penalties are all mutually exclusive, meaning the penalties do not stack. Only one can be assessed against you per year. The IRS's first choice for penalty is typically the 20% substantial understatement penalty. However, the IRS will often also assert the 20% negligence penalty as a backup position just in case the substantial understatement penalty does not stick. And if the IRS thinks it can prove you intentionally understated your taxes, it will assert the 75% civil fraud penalty. Let's first talk about the 20% substantial understatement penalty. The statutory authority for this penalty is IRC 6662D. This penalty is assessed if the amount of understated tax reaches a certain level, and that level is almost comically low. For an individual, all the IRS needs to show is that the tax on your return was understated by the greater of 10% of the tax that needed to be shown, or $5,000. In the vast majority of the audits that I see, the adjustments the IRS initially proposes are typically far above that standard. In fact, if the IRS did an initial review of your return and truly thought that the adjustments would amount to less than $5,000 and not meet the substantial understatement criteria, they probably would not have selected your return for audit in the first place. However, there are circumstances where the taxpayer fights back and reverses enough of the revenue agent's adjustments to fall below the substantial understatement criteria. That is why the IRS often packages the 20% negligence penalty as a backup position just in case. Next, let's talk more about the 20% negligence penalty. The statutory authority for this penalty is IRC 6662B. Negligence is defined in Treasury regulations as any failure to make a reasonable attempt to comply with the provisions of the Internal Revenue laws or to exercise ordinary and reasonable care in the preparation of a tax return. Negligence also includes any failure by the taxpayer to keep adequate books and records or to substantiate items properly. The negligence standard is a subjective one, which is why it's usually asserted as the IRS's secondary position rather than their primary position. But asserting this penalty as a secondary position is very important for them, because it means that they can penalize you even if the final adjustments fall below the criteria for the 20% substantial understatement penalty. Now, let's talk about the highest civil penalty the IRS can assess during an audit. It's the 75% civil fraud penalty under IRC 6663. To prove fraud, the government must show that the taxpayer intended to evade taxes the taxpayer knew to be due and owing by conduct intended to conceal or mislead. Unlike the substantial understatement and negligence penalty, for the civil fraud penalty, the burden is on the government to demonstrate by clear and convincing evidence that there was an underpayment of tax and it was attributable to fraud. Now let's talk about how we fight these penalties. The process to fight the 20% substantial understatement penalty and 20% negligence penalty is the same: by demonstrating reasonable cause. Treasury regulations define reasonable cause as the exercise of ordinary business care and prudence. If the IRS asserts either of these penalties, the burden is on the taxpayer to show reasonable cause on why their taxes were understated. To dispute these penalties on reasonable cause grounds, you must submit a written statement to the IRS describing how your conduct meets reasonable cause criteria. And the timing of submitting this statement is critical. Namely, you must submit your reasonable cause statement and request for the removal of the penalty before the penalty is assessed, or, put simply, before the audit closes and your appeal rights expire. Once the audit closes and your appeal rights expire, removal of these penalties becomes far more challenging and is not guaranteed, even if your conduct fully meets reasonable cause grounds. For the 75% civil fraud penalty, there is no reasonable cause defense. However, unlike the other two penalties, the burden is on the government for this penalty to show that you intended to fraudulently underpay your taxes. Fighting this penalty involves attacking IRS arguments that you knew you were committing fraud during the act, or demonstrating that your conduct was a mistake, or that you were unaware that your actions constituted fraud. Because the 75% civil fraud penalty only applies to the portion of the understatement attributable to fraud, you could also argue that only a small portion of your understated tax was due to fraud. If the IRS asserts the 75% civil fraud penalty, it is once again crucial that you timely submit your written protest and fight the penalty. Because the IRS bears the burden on proving this penalty, there's a decent enough chance that just by fighting it, the IRS may agree to reduce it to the 20% negligence penalty. If you do not fight the civil fraud penalty and it is assessed to your tax account, it can have a far-reaching impact beyond the mere need to repay. A fraud penalty determination can impact applications for federal loans, can disqualify you from some government jobs, and can trigger disclosure requirements or lead to discipline from state licensing boards if you're an attorney, CPA, doctor, financial advisor, real estate agent, or others. Taxpayers should always challenge the IRS if it asserts the civil fraud penalty. To wrap up, when the IRS completes an audit of your tax return and finds understated tax, it is very likely to assert the 20% substantial understatement penalty, the 20% negligence penalty, or both in the alternative. The 20% substantial understatement penalty is applied based on a mathematical formula, while the 20% negligence penalty is subjective and based on the facts and circumstances. Once asserted, the burden is on the taxpayer to show that they have reasonable cause to explain why the taxes were understated. If the IRS thinks it can prove you intentionally understated your income taxes, it will assert the 75% civil fraud penalty. Unlike the other penalties, the burden is on the IRS to prove that you knowingly and intentionally understated your income tax. Taxpayers' primary route to fighting fraud penalty assessments is by arguing that the conduct that led to the understatement was unintentional or due to a mistake. For all penalties, timing is vitally important to fighting them. Specifically, you must formally protest the penalty in writing before the audit closes and your appeal rights expire. After your appeal rights expire, even with great facts, removal of the penalty becomes vastly more difficult. If you are involved in an IRS audit and would like some help, schedule a consultation today, and let's talk about your case. I'm tax attorney Dan Urban with Urban Tax Law. We look forward to hearing from you.